Describe balance day adjustments and their purpose. This is an adjustment you need to make at the end of the financial period. These adjustments are made to certain accounts, including assets, liabilities, and owner's equity. This adjustment will correctly show the health of the business by bringing down the accounts and setting them up for the next financial year. Describe general purpose for financial statements. The statement of profit or loss consists of two accounts, revenues and expenses. Revenues show the money earned to the business, where expenses are the cost of operations, which create the revenue. These in the statement of profit or loss associate to form the profit of the business based on money spent and earned. Assets, liabilities, and owner's equity undergo the formula A equals L plus OE, which generate the assets the business owns. The general purpose of these as a whole is to identify how financially stable the business is. Describe accounting concepts and principles. The accounting period concept is a definite period of time that covers certain accounting functions, which can be anywhere from a week to a full financial year. An accounting entity is a clearly defined unit that safekeeps certain transactions. These concepts are essential in creating financial statements as they allow for consistent reporting. The monetary principle states that when business transactions or events occur, they are first converted to cash, then recorded in the financial accounts. The historical cost principle states that most assets are to be recorded on the balance sheet at their historical cost. Explain the limitations of the statement of profit or loss and the statement of financial position. Although these statements provide the status, condition, and position of the business, resulting in whether or not the business is financially stable to continue, there are limitations. These being, does not account for fraud, not adjusted for inflation, derived from historical costs, no precision, and they do not cover non-financial issues. Having knowledge of these factors can result in a reduction in investing funds in a business or actions taken to investigate further. Explain the relationship between assets and negative asset accounts. The provision for doubtful debts account allows revenue recorded in the period to be offset against a relevant expense in the same period. Provision for doubtful debts is an estimated figure only based on accounts receivable who may or may not be able to pay their debts in the next accounting period. This estimate is based on past experience regarding unpaid accounts. Precision for doubtful debts is a contra entry that offsets the balance of accounts receivable in the statement of financial position. What are provision for doubtful debts? This is a negative asset, with the purpose of this account is to estimate present accounts receivables that are unlikely to pay their debts in the next accounting period. What are bad debts? Bad debts is a financial expense that a business incurs once the repayment of credit previously extended to a customer is estimated to be uncollectible. This is a contingency that must be accounted for by all businesses who extend credit to customers, as there is always a risk that payment will not be received. Profitability ratios. Net profit. Net profit over net sales times 100. This shows the relationship between net profit after tax and net sales. This reveals the remaining profit are all costs of production, administration, and financing have been deducted from sales/revenue. Gross profit. Gross profit/net sales times 100 measures the performance and efficiency of a business, used to examine the ability of a business to create sellable products in a cost-effective manner. Return on owner's equity ratio. Net profit over average owner's equity times 100. This shows how much money is returned to the owner as a percentage of the money they have invested or retained in the company. Liquidity ratios. Rate of turnover of accounts receivable. Net credit sales over average accounts receivable. This measures a business's effectiveness in collecting its receivables or money owed by clients. This shows how well a company uses and manages the credit it extends to customers and how quickly that debt is collected or being paid. Rate of turnover of inventories. Cost of goods sold over average inventories. This measures how fast this business sells inventory. This may indicate a problem with the goods being offered for sale or a result of too little marketing. Statement of profit or loss. It goes sales, less sales returns, less cost of sales, which are cost of goods sold, inventory adjustment, which equal the gross profit. Then you got to add other operating revenue, which could be interest revenue, commission, any of that. Then you less expenses, selling expenses. These are cartage on sales, advertising, delivery vehicles, etc. Then it goes administrative expenses. These are wages, telephone expenses, depreciation on motor vehicles, and many more. Then it goes finance expenses, which are bank charges and bad debt. Now this total equals the net profit. The bank overdraft figure has also increased by 53,000, which is obviously bad, meaning that they need to decrease this by having more cash sales and a greater credit policy. Seen stimulus assumptions. Assuming profitability, they need to increase cash sales, which means they can offer discounts on cash items to do so. They also need a better credit policy to decrease doubtful debts. They can also get a new supplier, as cost of goods sold have increased by 23%, which is 18,000, where sales have increased, which is good. However, sales returns has also increased by 19%, or $15,000. They need better quality products to reduce returns, even if this means sacrificing some sales, as in the long run may benefit the business's sales. Customer satisfaction will affect future sales. Other assumptions. I'm assuming they're going to, on the exam, is going to write changed credit days from 60 to 90 days, whereas they really should reduce from 60 to 30 as soon as possible. From 60 to 90 is a bad idea, as this business requires money as soon as possible to decrease bank overdraft and reduce the bad debts account to stop the trend. I'm assuming it also might say all staff are giving out credit to who asks. They need a better credit policy, meaning they need a credit manager, which checks credit history, sufficient funds to identify if they will get paid on time. If not paid on time, they need to charge more money. If not, they need to charge more money. They also need to be proactive by sending messages, emails to stop the increase in bad debts.